Hi, this is Becky Spain, and in this lecture we will be covering Chapter 2, Money Management Skills. As we learned last week, you either manage your money or your money will manage you, and how well you do this will impact your quality of life. Successful money management is based on organized financial records, accurate personal financial statements, and effective budgeting. This chapter offers a discussion of the importance and the type of financial documents that you'll need. So let's begin by looking at our learning objectives for this chapter. Our objective number 1, identify the main components of wise money management. So successful money management requires a coordination of your personal financial records, your personal financial statements, and your budgeting activities. An organized system of financial records and documents should provide ease of access as well as security. And the security is really important because some of your financial documents may be impossible to replace. So you'll want to make sure that you have stored those in a secure way. Our learning objective number 2, create a personal balance sheet and cash flow statement. We're going to go over step by step how to do that tonight, and I know that will help you with your homework assignment as well. A personal balance sheet is also known as a net worth statement. It's prepared by listing all items of value or all of your assets and all amounts owed to others or what is known as liabilities. The difference between your total assets and your total liabilities is considered your net worth. A cash flow statement or a personal income and expenditure statement is a summary of cash receipts and payments for a given period, such as for a month or for a year. Learning objective number 3 is to develop and implement a personal budget. So the budgeting process involves 7 steps, and we'll go through these one by one, but you want to set financial goals, you want to estimate your income, you want to budget emergency funds and savings, you want to budget your fixed expenses and then your variable expenses, you want to record your spending amounts, and then you want to review your spending and savings patterns. And then for our 4th learning objective, for personal financial goals, you'll need to connect money management activities with savings. Savings, what we all want to have, but none of us want to actually take the time or the effort or make the sacrifices to put back. Unless, of course, you are a saver by nature. My husband is a saver by nature. I am not. It's a discipline for me to put funds away, but I'm always happy when I do. So as we connect money management activities, we're going to find that the relationship among the balance sheet, the cash flow sheet, and the budget provide the basis for achieving your long-term financial security. Future value and present value calculations, which we talked about last week, may be used to compute the increased value of savings for achieving your financial goals. Start with our learning objective number 1, which is to identify the main components of wise money management. Money management refers to the day-to-day financial activities necessary to handle your current personal economic resources while working toward long-term financial security. Your day-to-day spending, or will I save, these decisions are central to your plan. And like we talked about last week, these decisions must be balanced with where you are in your life cycle and other factors like our current economic situation and the town where we live and work, those types of things where we are in our stage of life. Those will impact your decisions. What are the components of money management? The foundation for planning and implementing money management activities are your personal financial records, your financial statements, and your spending plan or your budget. To accomplish all of this, you'll need a system for your personal financial records. This system needs to include records of your money management records, your personal and employment records, your tax records, your financial services records, your credit records, your consumer purchases records, housing and automobile records, insurance records, investment records, and estate planning and retirement records. Create a system where you can store and find all of these items. Moving on to learning objective number 2, we are going to create a personal balance sheet and a cash flow statement. A personal balance sheet and cash flow statement provide information about a person's or a household's current financial position and a summary of current income and spending. So your personal balance sheet is the starting point. So let's start by looking at what goes on a personal balance sheet. I would refer you to page 49 in your book at this point because it gives a really great example of a balance sheet, and if you will use that as we go through these comments, I'm sure that this will help you considerably to be able to follow along and be able to apply this lesson more effectively. So your balance sheet is also known as your net worth statement. It specifies what you own and what you owe. The formula is items of value minus amounts owed equals your net worth. Begin your balance sheet by looking at your assets. Assets are cash and other property that have a monetary value. The first type of asset that you want to list is your liquid assets. Liquid assets are cash and items of value that can easily be converted into cash, such as the cash that's available to you in your checking account, your savings account, if you have a money market account. Next, you're going to list your real estate assets. Real estate includes things like your home or condominium, vacation property, or other land that you or your family may own. The next asset that you want to list are your personal possessions. For most people, personal possessions are the major portion of their assets, and they include things like your car, your furniture, jewelry, computer, those types of things. Finally, the last category is your investment assets. Investment assets consist of money set aside for long-term financial needs, such as for your retirement account, your assets. Then let's move on to step 2. Step 2 is to determine amounts owed or the liabilities that you have. Liabilities are amounts owed to you. Liabilities are amounts owed to others, but don't include items not yet due, such as you wouldn't want to list next month's rent since it's not due yet. You want to begin listing your liabilities with your current liabilities. Your current liabilities are debts that must be paid within a short amount of time, usually less than a year. This may include medical bills, credit card charges, your auto loan, or other loans that you might have out. This would exclude your home loan because that is a long-term liability, which is what goes on the next line. So step 3 is your net worth. Your net worth is the difference between your total assets and your total liabilities. So in other words, assets minus liabilities equals net worth. So let's talk about insolvency for just a quick second. Insolvency is the inability to pay debts when they are due. It occurs when when a person's liabilities far exceed his or her available assets. A person may have a high net worth but still have financial difficulties. Having many assets with low liquidity means not having the cash available to pay current expenses. This happens a lot of times in business, but can also happen in home expenses as well. So let's look at some ways to increase your net worth. You can increase your net worth through one of 4 ways, or all of 4 ways. You can increase your savings. You can reduce your spending. You can increase the value of your investments in other possessions, or you can reduce amounts owed. But the only way to improve your net worth is to do one of these 4 things, or 2 or 3 or 4 of them. Remember that your net worth is not available money to use, but an indication of your financial position on a given day. It's a snapshot in time. We're going to look at the cash flow statement. There's an example of a personal cash flow statement on page 52 of your textbook, and it would be helpful, I'm sure, if you could have that open and follow along as we move through the steps on how to prepare a cash flow statement. I think it will help you to have a deeper understanding of the material that we're covering. So your cash flow statement calculates your inflows and outflows. Cash flow lists the actual inflow and outflow of cash during a given period. And your cash flow statement is a summary of the cash receipts and payments for a given period, such as a month or a year. So your cash flow statement takes your total cash received during the time period minus the cash outflows during that same time period, which equals your cash surplus or your deficit. Let's take a closer look. To create a cash flow statement, the first step is to record your income. So income is the inflows of cash to an individual or to a household. For most people, the main source of money, the main source of your income is money received for a job. Once you've listed what your pay is, you're going to list the gross amount, and then you're going to list how much is coming out for your federal income tax, your state income tax, and your Social Security, so that you can see what your total deductions are from your check and have the amount that's left available to pay bills after that. Is to record your cash outflows. You want to look at the cash payments that you are making for living expenses and other items. You're going to begin by listing your fixed expenses. Those are things that are the same every month, such as your rent, your cable, your internet, various insurances. Then next you want to list your variable expenses, and these are flexible payments that change from month to month, such as like what you spend on food or eating out, entertainment, clothing. Most likely your electricity bill changes from month to month, so that would go under your variable expense. Then step 3 is to determine your net cash flow. The difference between your income and your cash outflows can either be positive, meaning you have a surplus or extra left over, or it could be negative, meaning that you already have a deficit in your cash flow. A deficit, I think I need a drink of water. A deficit exists if more cash goes out than what comes in during the month, and this amount must be made up by withdrawing from savings or borrowing, or having outstanding debt that's not been collected by debtors. Over how to create a personal balance sheet and a cash flow statement, we are ready for objective number 3, which is to develop and implement a personal budget. Once again, I think that using the example in your book and having that in front of you as you listen to this lecture will be very helpful to you to be able to follow along with what's being taught. So your budget or your spending plan is necessary for successful financial planning, and the main purposes of a budget are to help you to live within your income, live within your means, which really is one of the main reasons that people get into financial trouble. They don't know where they are and they're not living within their means. The second is to spend your money more wisely, having the information that you need to make wise choices to help you to reach your financial goals and prepare for financial emergencies, as well as to develop wise financial management habits. So budgeting may be viewed with these 7 steps, and we're just going to walk through these. Your lifestyle is how you spend your time, your money, and it strongly influences your career, family, and your personal values. And we talked about that a little bit in chapter 1. So step 1 is to set financial goals. What is it that you hope to accomplish? For this example, the person who is doing this is looking to reduce credit card debt, as well as to increase the amount in their emergency fund. How much you budget for various items will depend on your current needs and your plans for the future, as well as your lifestyle. Sources that can assist you with planning your spending include your cash flow statement and sample budgets, articles in like personal financial planning magazines, and then estimates of future income and expected inflation. Number 2 is to estimate your income. Now, if you have a fixed salary or amount of money that you make each month, it's pretty simple to come up with that. But a lot of people have seasonal or bonuses, or they work on commission, and that makes this number a little bit harder to come by. You want to make sure you have a realistic number here, and if anything, underestimate rather than overestimate. It's great if you can take what happened last year at this time or what's been your experience and use those numbers to give you some idea of what to expect. Step number 3 is to budget an emergency fund and savings. An emergency fund and savings are irregular payments, and they should be set aside first to avoid not having anything left over. So a good way to look at that is that you need to consider savings as paying yourself, and you need to pay yourself first. So take that out first. Then step number 4 is to budget your fixed expenses. These are your definite obligations, your rent, your mortgage, credit card payments, all of this should be allocated next. Assigning amounts to spending categories can be based on your cash flow statement, current magazine articles, and then estimates of future income and expenses. If you've kept a spending diary of past expenses, this can also be very helpful. Then step number 5 is to budget your variable expenses. This can be a little bit more difficult to do than your fixed expenses, since the amount can fluctuate based on the situation, the time of year, health, economic conditions, and lots of other factors. Step number 6 is to record your spending amounts. And then your budget variance is the difference between the amount budgeted and the actual amount received or spent. A deficit will exist when your actual spending exceeds what you plan to spend, and a surplus is when actual spending is less than what was planned. Step number 7 is to review spending and savings patterns. The results of your budget should make it obvious. You either have extra cash or you're falling behind in payments. Or the results may need to be reviewed in detail to determine areas that you need to change. The most common overspending areas are entertainment and food, and especially eating out at restaurants, which we all love to do. At this point of the budgeting process, you should also evaluate, reassess, and revise your financial goals. You need to think of this as a circular activity where you're constantly looking back to make sure that what you're doing is what you want to be doing and how things are working out, so that you're constantly assessing in a circular motion. On to our learning objective number 4. We're going to connect our money management activities with savings for personal financial goals. Your personal financial statements and your budget will help to achieve financial goals, with the balance sheet reporting your current financial position or where you are now. The cash flow statement is going to tell you what was received and what was spent over the past month. And then your budget is your planning for your spending and your savings in order to be able to achieve your own financial goals. Having a plan for savings is critical to your financial plan. You need to select a savings technique. People who are unable to save regularly are usually individuals without specific saving goals. People who always seem to use up savings for unexpected expenses, those who overuse their credit or their credit cards, people who buy to have the same thing as others have, which sometimes, as we talked about earlier, are impacted by advertising, and then individuals who lack common financial goals with other family members. I shared earlier that my husband is a saver and I'm not, and it took us a few years of marriage to get on the same page there. He was constantly wanting to save, and I was constantly wanting to knock out things that we had on our list that we wanted to purchase or vacations we wanted to take, those types of things. So you need to be on the same plan with others who share that same financial pot with you. Since most people find savings difficult, financial advisors suggest several methods. One of the things that you can do is to write a check each payday and deposit it in a distant financial institution. That way it makes it a little harder to get to those dollars. You can use payroll deductions or direct deposits. A lot of times you don't miss the money because it was never deposited into your account. It's just part of what comes out of your check, like your taxes. You can save coins, and you'd be surprised sometimes how much you can save in saving coins, but don't let that be your only savings. and then spend less on certain items with the thought that the money that you're not spending is being used towards savings. The last slide on chapter 2, and I want to just wrap this up with a few quick tips about getting out of debt. You have to remember that when you're in debt, the money that you're paying for interest is going against you. You can never get ahead as long as you're constantly having to pay out money for interest. But if you can get to the point where you're not paying out interest, but you're actually putting money back so that interest earned is savings in your pocket, then that is how you can get ahead and reach your financial goals. So if you are in debt, you need to create a budget that allows you to actually have a surplus at the end of the month. And if you put it all on paper and it's not working out that way, you'll need to make adjustments until you can get it to that point. You need to evaluate your credit situation. You need to remember that credit cards are terrible traps at incredibly high interest rates, and credit card companies make those low payments way too attractive, but they only stretch out your payments over an incredibly long period of time and cause you to pay back much more than what you ever borrowed. Be sure that you're tracking your spending. Plan to make your payments on time, because those late fees really add up quickly. They work against you. You need to consider other income sources to perhaps get you to the point where you are not running in the red. And if appropriate, seek assistance. There are organizations that will work with you at no cost to help you to balance your budget and to come up with a plan to get out of debt. They'll even help you to work with your creditors to figure out how to come up with payment plans that are a little bit more palatable. So don't forget that the full deck of the PowerPoint presentation has been posted for you. Going over the PowerPoint deck can help you with your homework this week, as well as it's a great way to have study notes available to you. And then finally, be sure to also view the supplemental videos that have been posted. These are incredibly helpful, and because we are working to keep these lectures at a reduced amount of time, I'm hoping that you'll take the additional time and to look at the supplemental videos. I'm available should you have any questions, and I look forward to seeing you again next week.